It's my great pleasure to welcome you here to the Center for Global Finance seminar today. And we are absolutely honored to have with us here an icon, a person who is on the top of our researchers globally, Professor Dr. Kabir Hassan. I'm indebted to him on many points, but I'd like to especially spend a minute or two about his role as a distinguished professor, globally in finance, and he's the professor of finance in the Department of Economics and Finance at the University of New Orleans in the U.S. But actually, he holds 3 endowed chairs. That's 3 jobs in one, basically. As the Hibania Professor of Economics and Finance, the Hancock Whitney Chair Professor in Business, and the Bank One Professor in Business, all tenable at the University of New Orleans. But he has also had distinguished honors throughout his career. For example, he's the winner of the 2016 Islamic Development Bank IDB Prize in Islamic Banking and Finance. And this is a very coveted award globally, and awarded to many scholars from all over the world, so has to be absolutely distinguished. And in terms of the background, he took an BA in Economics and Mathematics from Gustav Adolphus College in Minnesota, an MA in Economics and a PhD in Finance from the University of Nebraska-Lincoln in the US. And he came to university with many distinguished achievements in his education, including being one of the top scholars results from his earlier education before university, top in the country and top in Bangladesh in 1980 exams. Well, basically, he's a financial economist, dominates the world of banking and finance, and working in diverse areas, including development finance, money and capital markets, Islamic finance, where he's really done a huge impact, corporate finance, investments, monetary economics, macroeconomics, international trade and finance. And through this portfolio of areas and research, he has inevitably conducted consulting work as a distinguished consultant for many international organizations, including the World Bank, the International Monetary Fund, the African Development Bank, where I used to be, and he was very active there, the Transparency International Bangladesh, the Islamic Development Bank, the United Nations Development Program, UNDP, the Bangladesh Bank, the Saudi Arabian Monetary Authority, SAMA, which is the equivalent of the central bank, and many governments, including the government of Turkey and many private organizations. I don't know where he gets his time and how he maximizes his time. Also, he has very big objective function, but he has also been elected a number of boards and becomes a board member of the Ethics and Governance Committee, the Education Board of the Accounting and Auditing Organization for Islamic Financial Institutions, IOFI, which is the global leader in setting up accounting and auditing standards for Islamic banks globally. And he has recently been appointed the Distinguished Visitor Professor at the National University of Malaysia. I could go on and on, including the recently elected role on the Advisory Council of the World Zakat Forum for 2021 until 2023. In addition to the visiting professorships he has held at Oxford University Said Business School, and also many other reputed organizations, including the Christine Mendelssohn Institute in 2021. But also, I should add quickly that he has a very important role and contributions in producing some of the PhD students that will become leaders in international organizations, governments, and other organizations. He has also provided leaderships on several organizations as the president, for example, of the Southwest Finance Association, the Southern West Society of Economists, Academy of International Business, and on and on. And I should not forget to mention about his ratings, which those stand in about 2% of the global contributions in finance globally. He would be cited as among the top 2% in the world, and hence his iconic role. He edits quite a number of distinguished journals in finance, and he's on the editorial board of more than 6 journals, including editing some of the, as editor-in-chief of the International Journal of Islamic and Middle Eastern Finance, and also some review of international business and finance, and many other journals in our field. I could go on and on, but I will be depriving you of the time to listen to Professor Dr. Kabir Hassan. Kabir, we are most honored to have you in your distinguished role to deliver a seminar here today. We very much welcome. The floor is yours.
Good morning from New Orleans, and good afternoon in London. Thank you very much, my virtual friend, Victor Murinde, a very distinguished professor himself. We never met each other personally, face to face, but I'm very familiar with his work, and it's good to hear so much beautiful words about me. Well, today, I will be talking about the digital financial inclusion and bank stability. I mean, what really prompts me to do this research? I believe in finance justice, financial inclusion, access to finance. I come originally from Bangladesh, the country of Professor Mohammad Yunus, the good gentleman who established DFI-bank, and his motto is a credit for everyone. If you give credit, you can change the poverty situation. So this paper has gone through many revisions. I'm presenting one revision. We have been asked to revise and submit to Journal of Financial Stability. Hopefully, eventually it will get published. So this is the outline of my presentation. Of course, the motivation, a snapshot of existing literature, what we plan to contribute here, data methodology, main results, conclusions, and policy implications. By the way, my co-author Hassan recently moved to Manchester Metropolitan University in UK from Malaysia, and he is in the audience. And Mamunur Rashid, he is in Brunei, but he will soon be joining the British University as well. So the motivation, you know that unbanked population in the world, there is a different studies. Some people say that 65% of the adult population do not have access to finance. And if you have digital finance, if you can introduce, that's going to bring the financial exclusivity and make more people within the mainstream financial framework. So the growing interest in stabilizing the financial system and enhancing the financial inclusion due to the global financial crisis that prompted the whole thing, the technological innovation, and recently COVID-19 pandemic. Now, digital financial inclusion advances the financial inclusion, the traditional measure that we used to FinDex database, the World Bank database they used to do, by offering access to and active use of affordable financial products and services to billions of currently unbanked adults, and ultimately helps to stabilize the banking industry. Now, there are few studies have also considered their interconnectedness but found mixed evidence. Now, the question is there a synergy or trade-off between digital financial inclusion, financial stability nexus in the global banking perspective. So we investigate whether the advancement in digital financial inclusion to stabilize the global banking sector using bank level microdata. We explore, is there any synergy or trade-off exists between DFI and bank stability, while at the same time considering various environmental settings such as regional level, income group level, bank size, bank types, individual, underprivileged group. And we have only one hypothesis. We try to examine whether digital financial inclusion positively influences financial stability of banks. Now, if you look at the existing literature on the financial banking stability, the bank stability with other factors, what causes bank stability and market competition, bank regulation, bank size, too big to fail, financial liberalization, interest rate, monetary policy, and so forth. And these nexus of studies have found mixed results. Some of these variables positively impact financial stability. Some of these studies negatively impact financial studies. And here are some references, as you can see on the screen. If you look at the financial inclusion, on the other hand, the positive effect of financial inclusion on socioeconomic indicators are either anecdotal, people talk about this case study level, or use simple analysis at the macro level, not going into the micro level that we are trying to do in this study. So what are those variables, macro variables? Economic growth, poverty reduction, income inequality, literacy, trust, religion. And there are a number of studies that I mentioned which looks at this trend of literature of financial inclusion. And one of the well-cited one is Demetra Kant. She is a World Bank economist, and she has a lot of money and access to data, and she is turned out a very good number of papers. By the way, for our benefit, for the scholarly community and for the policymakers. Now, if you look at the confluence between financial inclusion / digital financial inclusion and bank stability, now in this spectrum, combining both sectors together is very scarce. So they talk about from the theoretical perspectives, this is some of the research that I found out. There is also financial inclusion, bank stability or bank risk taking. Again, there is a mixed results. Now, a group of scholars find positive impact on FI on bank stability. Like Ahmed and Malik is a well-cited paper, and they have another version of it 2021 as well. Al-Samdi, my co-author Bandan Alom has one. We have recently got published one paper, International Journal of Financial Market Institutions and Money. And Dennisman and Tarazi, Van et al. Just came out 2020. And another group of scholars find negative impact of financial inclusion on bank stability. And one of the well-cited ones, Sihar 2060, Sahai 2060, and most recent one is a Wang 2020. So what we are trying to add to the literature? First, our study consider recent data up until 2020 and variations when compared to Ahmed 2021 and other recent studies. We further categorize these banks into several groups based on region. The World Bank, 6 different regions. We categorize them, cut the data, and look at individual region-wise. We look at the size of the bank. We look types of the bank, whether it's a development bank, Islamic bank, conventional bank. We look at the concentration. Second, a good number of studies limit their findings within the macro perspective of financial inclusion and bank sector stability nexus. Ahmed and Malik is one of them, but we provide a combination of bank level and macro data for the global banks. So we do not confine ourselves only to macro perspective, we bring the micro as well. Third, the impact of both demand and supply of digital financial inclusion indices on bank stability would be interesting findings for the banks and policymakers. So there is a demand side of digital financial inclusion. signifies the use of digital finance, and whereas the supply side of digital financial inclusion indicates the access to digital finance. And you probably are aware of, there's a lot of talk going on right now about central bank digital currency. And of course, we have the cryptocurrency, the blockchain technology and so on. Only a few recent studies equally consider the importance of both the supply and demand side of DFI, or digital financial inclusion. Now, 3 digital financial inclusion indices that we create, we call overall, supply side and demand side, allow us to observe the year, region, and country-wise in-depth variation in the digital financial inclusion indices to explain policy implications. And finally, the disaggregated data of individual adults allows us to investigate how the characteristics of the underprivileged adults contribute to DFI bank stability nexus. So where we are getting our data from multiple sources, we have annual data of 1,431 banks or 14,313 bank year observations. We have to have a 3-year data on each bank to be included in our sample, because some of the variables that we calculate, we need this rolling 3-year data. We have 56 countries and 6 geographical regions: East Asia and Pacific, Europe and Central Asia, Latin America and Caribbean, Middle East and North Africa, South Asia and Sub-Saharan Africa. And period 2011 to 2020, and you might ask, why is 2000 and not before then? Because some of the data set starts with 2011. So bank level data, we get Bank Focus, we have the Financial Access Survey, IMF, Findex, World Bank, World Development Indicators, and of course different literature we rely on in order to choose the variables or the method and the technique that we use in this paper. So what is the methodology? So baseline analysis, we use Cameron, Galbraith and Miller two-way clustering estimation technique with heteroscedastic corrected clustered robust standard error. By the way, it's a very loaded word, but all the econometric software allows you to do it very easily. You have to just understand the econometrics behind it. So our dependent variable is Y is a Z-score with the Sharpe ratio and standard deviation of return on equity as dependent variables, which are the proxies for the bank stability of bank I, country J in year T. Then we have the digital financial index variable, and as I said, there are 3 ways we calculate this: overall, or supply side, demand side, and we use a principal component analysis from the Findex database to calculate these indices. So that was a work by itself, calculating these indices, which we later use in our empirical work. Then we have the bank specific factors such as size, loan ratio, loan loss reserve ratio, independence. So these are the variables that has been used in the literature previously. Then you have the macroeconomic factors such as inflation, GDP growth, GDP, GG, unemployment, and so these are the variables also used in different studies. Now, of course, when you deal with panel data, you have the issue of endogeneity, and we have to address the endogeneity, because when we say that digital financial inclusion is reducing or increasing or improving financial stability, there has to be A to B. So we have to take out of the confounding factors in between. That's the endogeneity question. The identification as well goes with this. So address this endogeneity in the form of reverse causality. We combine CGM clustering technique with a 2-stage panel least squares instrumental variable approach. We also, in order to remove the unobserved time invariant bank specific heterogeneity, we use a 2-step system generalized method of moments. We also cut the data in the quantile regression to check whether DFI had homogeneous effect at different points at the condition of distribution of bank stability. We also use alternate proxies for digital financial inclusion, like the percentage of adults made or received digital payments in the past year. We have the subsample based region, as I say, 6. We have the subsample based on income level, high versus middle and low income, bank type, conventional, cooperative, Islamic, and savings. And this categorization coming from the bank focus database. We split the sample also financial development, high financial development, low financial development. We also look at the traditional financial inclusion, high versus low, and we sort of interact and see if you have traditional financial inclusion and if we interact with digital financial inclusion, that is a more added explanatory power. And also look at the future financial stability and also past financial stability. Additional analysis, the variables of account and made of received digital payment in the past year show the individual characteristics. So we bring the gender issue here. We have a gender inequity by doing the digital financial inclusion as well. There are more male than female. We have the age, young adult 15-24, older adult 25 plus. We have the question of the employability, whether they're employed or unemployed, educational level, educated, undereducated. We have to also divide between rural and urban. Income level, the richest 60% and poorest 40%. So these are our main findings. So if you look at lean z-square and standard deviation return on equity, so the relationship is here is positive for the overall. DFI access is positive and DFI uses is positive. So here this positive relationship means that digital financial inclusion contributes to financial stability. So if you look at the lean standard deviation, then that means negative relationship means that this variable itself improves financial stability. So if you look at just a table to give you an idea, so we figure DFI by country and we have said 56 countries. So if you look at this DFI, the overall Tanzania has is a good position, and the worst of the countries are probably Iraq almost 0, Afghanistan 0.006. If you look at the access, Rwanda and somewhere between the other countries, if you look at the usage variable from the financial inclusion, Malaysia is on the top. Now, if you look at the Z-score figures, so these are the region-wise. We have the bank stability Z-score year-wise relationship. So we have said there we have 6 different regions. So these are the pattern of the relationship. Now, from this previous table, our results suggest that a higher level of DFI or digital financial inclusion is significantly related to the higher level of banking stability. That means high Z-score indicates a greater stability and less restricting. Also, when DFI is enhanced in a country, the volatility of return on average asset is less and hence more stability is obtained. And the economic value of the findings suggests that the overall DFI has a significant impact on bank stability, which means this DFI improves the soundness of individual banks of the simple countries. Our results also indicate that inclusive financial system connects to the 3 major channels of relationship between digital financial inclusion and stability. First, the DFI offers economies of scale, inclusiveness and openness, stable deposits at low price, low monitoring cost and low risk, and these are consistent with the prior literature. Second, DFI can help mitigate financial constraints of SMEs, individuals, as well as increase financial mobilization. So we can say the banks can minimize the liquidity shortfall and achieve stability by reducing the pro-cyclicality of risk. And finally, using the measure of digital financial inclusion, banks can set their lending priorities, do proper client analysis using DFI, and plan to reduce non-performing loans and default risk. And DFI can also help control inflation rate, ensure greater access to remote areas in times of crisis, COVID-19. So there's a recent paper, you also find consistency with this type of literature as well. If you consider two disaggregated indices, our results also suggest that both DFI access and DFI users help increase the Z-score. However, the DFI access shows an insignificant but negative connection to the volatility of returns, and this may due primarily because of greater use of cash due to limited access to mobile and internet technology and services in some least developed countries. So they do not have the digital financial infrastructure to penetrate the wider population. Our control variables are also consistent with the existing literature, such as most variables have positively contributed to stability. However, Herfindahl index, learner index, and governance quality are found to be inconsistent or insignificant. So let's look at the robustness check, 2 Sls Ib. We get the same result as our baseline results. IB, the instrument here is a borrowed from friends and family and schedule economy. So in order to take care of the endogeneity problem. So this is the results. If you see again, so you have the 2SL IB is a positive relationship with Z-score and negative relationship with the volatility variable. If you look at two-stage dynamic GMM, we get the same result, but in this case, it the variable some way is contributing positively to the volatility. If you look at the quintile results are, if you look at DFI, digital financial inclusion, these are all positive and contributing positively to the financial stability or Z-score. If you use alternate proxy like DFI proxy, like OLS, PCSE, we also do two-stage D-squared. So you have, and remember that alternate proxy of the digital pay the last 1 year, we find OLS, the standard deviation is negative, but for the Z-score is positive. If PSC technique, another econometric technique, is positive, negative, 2S is positive, negative. So these are mostly consistent with our baseline regression. Now, if we look at the regional level, the bank's responses regarding the digital financial inclusion and bank stability nexus are heterogeneous among different regions. The responses by the banks in East Asia and Pacific, Europe and Central Asia, Latin America and Caribbean, Middle East and North Africa are not notable, while those of banks in South Asia and Sub-Saharan Africa are more sensitive. So these are the results we have in the paper. So digital financial inclusion, DFI overall, we have the region, and DFI access, we have the DFI uses. You'll see in many cases these variables are significant in the right direction. Some cases it is not significant. If you look at the income variable, DFI, BS, Nexus are heterogeneous among different income level in which banks in upper and lower middle as well as low income countries are more sensitive. So just to give you a feel for the data, so you have the digital financial inclusion, we have the high income group, and you have the other income group. So if you look at the high income group, digital financial inclusion here, and if you look at the other income group, it's significant. Now the point that we're trying to raise that these heterogeneous among different income in which banks in upper lower middle class as well as are more sensitive because they have a more room to grow, more room to penetrate the underserved or lower served population to the financial technology, to the digital financial inclusion. Now, if you look at bank type, DFI and BS Nexus are heterogeneous among different bank types in which conventional banks are more sensitive than their counterparts, Islamic, cooperative, or savings bank. So if you look at here, we have the conventional banks, positive, 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 cooperative bank, not significant, only users part is significant. If you look at Islamic banks, this is unfortunately is negative for the overall and DFI uses. And this sort of could be because of this heterogeneity, and Islamic finance has not taken root in different countries. Still people are doing conventional finance, but you have to understand that Islamic finance is also a growth factor. Savings bank, we do not find the results same way. Now, if you look at the financial inclusion and DFI confluence, the results show that financial development and traditional financial inclusion carry positive influence on bank sector stability while increasing with the digital financial inclusion regardless of their intensity. So just to give you a feel for the data, okay, financial development, the proxy, domestic private credit to GDP, you see this is positive and significant in all three dimensions: DFI overall, DFI access, and DFI uses. Traditional financial inclusion, again, we find this significant at two levels, at the overall and also with the uses. If we look at future bank stability or future Z-score, we find these variables also very significant. So we calculate Z-score one period forward. We also do the same analysis one period backward. We find the similar results. Now, if you look at future DFI, so I have given you that result as well. We have the FDA DFI. I given the result as well. FI. Sorry. So we got this thing. So let me make this okay. Now, if you look at the additional results, male, young adults, educated, employed, and richest, 60% have more account and they are main users of digital payment. So you have the account, you have the observation mean. So we do have this difference like male versus female is significant. Young versus aged, undereducated versus educated, poor versus rich, employed versus unemployed. So here we have the account number, and panel B, we have the made or received digital payments in the previous year. Now, if you look at the DFI, bank stability nexus are more sensitive to male, female, richest 60%, poorest 40%, employed, unemployed, young adults, and educated, underprivileged individuals. So we have the bank stability as a dependent variable. We cut the data into different, all these 11 different segments. The data can be cut into a micro level. And we have all the different control variables. If you have the account, positively affects in all categories except the unemployed. If you take the digital, made or received digital payment in the last year, we have also all these variables are positive and significant. Now, these are our main results. So let me conclude and also offer you some policy perspective. So I'm kind of a believer, we do research just to give something back to the society or the policymakers that is helpful. So we claim contribute to the literature of bank stability and financial inclusion. We measure a comprehensive digital financial inclusion and show the link with financial stability. That means measure means we constructed this comprehensive index. With an inclusive digitalized financial sector, banks are likely to enjoy greater financial stability. The heterogeneity of DFI, bank stability nexus, suggests that less sensitive banks need to expand their agent network and other access points and improve the design of their existing DFS products by implementing artificial intelligence or machine learning to charm all classes of individuals. So, worldwide there is a movement towards, financial technology because technology is growing at like exponential growth and the cost of using technology is reducing. So mobile banking is very popular in third world countries, but different technologies coming to the market, and the policymakers should look into the feasibility of this technology for the benefit of the greater masses in different countries. So there are three policy implications connection I want to make and say something. DFI, inclusivity, efficiency, and social responsibility. DFI helps raise low-cost, stable deposit It solves the pro-cyclicality risk. It helps solve the liquidity crisis, absorbs monetary shocks, and ensures diversification benefits for banks. An integrated inclusion of digital finance in the banking industry allows sustainable economic growth that is most likely to help maintain financial stability in times of crisis, such as our recent crisis COVID-19 and the previous crisis, global financial crisis 2008 and 9. Subsequently, banks can also achieve higher stability and operational efficiency by adopting DFI-based financial services. We have a series of papers in this family of literature that we are working on simultaneously using the same database. Banks also fulfill their social responsibility by covering a wide group of population that were previously unbanked, therefore had limited access to finance. And banks are suggested to focus on less inclusive areas by capitalizing on the agency network, mobile money agents, and other affordable digital financial schemes. Bankers and policymakers should also take privacy and consumer protection into consideration, because with digital financial inclusion allows our book to be open to everyone and allows to cyber security risk. Banks will have to invest more to safeguard the interest of the customers, and we hear every day there's a breach of a system, so we have to be very careful from the bank standpoint, for the business model, and also from the regulators and policymaker perspective to maintain the privacy of the data and the normal business flow. Policymakers should strengthen regulations to influence banks' policies on privacy, digital financial security, and digital deposit insurance. The second one is DFI, partnership and vulnerability. Demographic and geographic details from the study are supported in the policy notes by the multilateral development agencies such as the World Bank and IMF and other standard setters. As supported by several initiatives by MDAs, DFI can be an important policy vehicle to address partnership and cross-border harmonization, to influence government policies on digitalization and inclusivity. So there was study 2018 by UNSGSA and Sahai 2020. Several banks are in the process of upgrading their websites and offering mobile banking services to the point where individual borrower can do online credit assessment without formally applying to a bank. And DFI can also be an effective tool to address climate-related financial vulnerabilities and sustainable livelihood. For instance, World Bank played an active role in financial sector restructuring project in Bangladesh, which stressed on digital business indicators, banking sector restructuring project, and a 600 million investment to improve the skills of the poor and vulnerable groups to tackle the shocks. And third, regulated DFI, digital divide and agency problem. Our study raises three interrelated concerns that connect to both finance growth nexus and the potential agency problem. DFI is an investment to transform traditional banking business model. As growth of DFI is extremely heterogeneous among regions, we believe that its impact on relatively least developed nations may widen the digital divide. Consequently, in line with Barty et al. 2013, we believe that some large banks may take the advantage of technology arbitrage, as they can invest large sums of money in new technology. Hence, unless effectively regulated, DFI may result in unhealthy market competition, resulting in skewed efficiency and sustainability. Second, DFI may require training, awareness campaign, and teaching facilities to unfold the benefits of financial literacy. Least developed countries are still dwindling in basic literacy framework. They will require assistance, partnerships, and investment to integrate the importance of digital financial literacy and to save them from foregone privacy. Finally, DFI helps to reduce agency problem. However, it is not clear how this relationship between managers and other stakeholders will evolve in the new DFI-based business model. In line with the views presented, recent study by Kapart and Shanball 2013 and Boetel 2020, we also expect that future research will investigate how customer engagement and customer monitoring contribute to profitability and stability. So that is all, my dear friend, for listening to my presentation, and I am open for any questions that you have. So
thank you so much, Kabir. Absolutely interesting, very clearly presented. Excellent, thanks indeed. And also very inspiring. There are many aspects of this paper and the presentation and the way it's done that are really a signature of great work done. First of all, addressing a very critical issue. And I can see people from Central Bank, including the Deputy Governor of the Central Bank of Zimbabwe, say former Finance Minister Peter Ross. I think the policymakers will agree that it's an interesting question whereby for the last a couple of years, many countries around the world have been trying to move towards financial inclusion. And the advance of financial technologies mean that that financial inclusion can be digital. At the same time, when you look 10 years ago, we are trying to deal with the question of financial stability, especially bank stability, as a way of recovering from continuous global financial crisis, okay, and changing Basel rules to be able to cope. And so here as that financial regulators and the practitioners in the financial industry are concerned with both the work on digital financial inclusion, promoting it, but at the same time concerned with the issue of bank stability. And this work tries to reconcile those two critical issues. A novel methodology is used, very innovative econometric tools. So Kabir is not just putting any tool from the bag to try to apply to data. No, selectively looks for those tools that can actually shed important dimensions. And then, of course, the high degree of robustness. This paper will definitely be accepted. I can see from the work done. The testing for robustness, exploring all angles, exploring for endogeneity, exploring for different methods of measurement and definition, exploring for differences in samples, exploring for GSI, gender and social inclusion dimensions. I can't think of anything you have not really dealt with in terms of robustness. And then, of course, interesting findings. And one could even throw a lot of finance theory in here to explain some of the findings. Because the interesting finding is that basically digital financial inclusion actually supports bank stability. Okay, is not a danger to bank stability. And if you think in terms of financial theory, think about transactional costs. Digital financial inclusion is likely to reduce transaction cost. That alone means that banks can be able to run stably, and you don't get a lot of collapsed loans or bad assets because of high costs. Okay, so transaction theory is best. Transaction cost theory is relevant. So the findings absolutely are interesting, and then you have a lot of plausible policy implications. The observation you made are spot on. Why do an important study with good conclusions if we can't inform policy? This now in the UK here, we have a new word for impact, when you cannot have impact on policy and practice. Absolutely smashing. Thanks very much, Kabir. I was trying even to put in this dichotomy between linearity and non-linearity. And they suppose you could get somewhere like an inverted U curve or U curve, but maybe it doesn't work. But I was trying just to fit it in, except that you are too fast. You smashed it so quickly. I hadn't finished my homework of trying to fit in a nonlinear dimension and a possibility of a nonlinear relationship between digital financial inclusion and bank stability. Well done. Okay, so I'll open the discussion to the floor. I can see already two people with the hands up. Oh, how come one happens to be me? Most of the okay. Yeah. So the chair should not be putting up a hand here. Okay. We have another hand coming up by oh, by the way, very brilliant a scholar who is Aisha Demir, used to work with the Center for Global Finance, now a senior lecturer at Rampton, and actually follows your work so much, Kabir. So, Aisha.
Yes. Thank you so much, Kabir, for the great presentation, and thank you very much, Professor, for your great summary on this work. Actually, the points that I would like to raise that you already highlighted, but I have very few questions on the data. As far as sorry, my birds are singing, so I will change my room. They are very noisy. So let me change room because they are singing. So actually, my question is on the data. As far as I'm aware, Ahmed and Malik, one of the major papers in the financial inclusion and stability area, it's, I think, one of the pioneer papers, and they use supply side of data, financial access survey data in their paper in order to proxy financial inclusion. And one of your contributions, as you highlighted, was that you use both demand and supply side of financial inclusion. And as far as I believe so, you use global index to represent demand side and financial access survey to represent supply side. So my question is, what is your insight? How do you differentiate your paper from Ahmed and Malik by using the demand side data? And another question is, your time period covers from 2011 to 2020. And I think Global Findex has 2011, 2017, and 2014, 3 waves of data, while Financial Access Survey covers annual data from 2011 to 2020. So how do you compare, how do you make a data match between these two kind of data sets, which includes different number of time periods? So how do you make this balance, and what are the insights of using different supply side and demand side of data against to the existing literature which rely on the supply side data, especially Ahmed and Malik?
Okay, excellent question. So, with this IMF data, it has a continuous data, so that's not a problem. But for the Findex database, you're right. But like other scholars, so we do these things with sort of smoothing. So we assume a certain growth rate. So we create data like 27. So the smoothing technique, so that's the way we create a generate data. So this is the technique people use, but there is a criticism whether when you do this, you are creating a trend to the data, but shoot me for that, but we cannot do anything more than that. So that's the way we are creating a continuous, the time series data. And I think we also follow, I forget the name, is it Ahmed or somebody else's paper, in order to create this a continuous spectrum from the Findex database. You are perfectly right when you say that how do we manage it. That's the way we sort of create this continuity of the database. So this is something, it's not our total innovation, other people have used it. And actually I have used this thing in my earlier part of my career, also Victor as well. You know, when you deal with the money supply demand, when the data is missing data, we try to extrapolate data. So that's the technique that we have used. So that is the first part of the data related question. And the second part, how it is different, we in our paper we say very exactly, I do not know, maybe Ahmed is our reviewer of the paper, so made the first pass. Actually, we try to do a lot more than what Ahmed and 2019 and 2021 paper did. They just look only one dimension, and we look at the comprehensive, we bring the both uses and access dimensions in this analysis. We cut the data in different ways. We try to sort of disaggregate it. So if you say that their paper is a mother paper, our paper is children with many children, so trying to boost up their own result. So that's all I can tell you, I say.
Yes, yes. In the paper, they use access and use, and I think they create a principal compound analysis with the access and use data. So using a disaggregated data and two types of data, demand and use, demand and supply data is also quite innovative. But my question is, did you get any insight by incorporating demand side data? Did your results differ from what Ahmed and Malik found? So is it significant to incorporate demand side as well? Is there any like remarkable result that
I think our results, if I mostly remember, that are mostly consistent with their findings. So we are not contradicting anything that they have done. But we claim that we sort of take it one step forward. I mean, it's a value addition. So if you take this, as I said, their paper is a mother paper. We are sort of children, with many children trying to boost up their result and telling the sons to, okay, digital finance inclusion do have an impact of financial stability. Just for your knowledge, we are also looking at the efficiency question, whether digital financial inclusion contributes to efficiency. We also look at the type of banks, specifically Islamic bank and conventional banks, how they differ with the digital financial inclusion. Having said this, while I'm answering a question, I also am asking the audience, because it's a global center. I know you have a lot of audience from African countries. I am editing 2 books on Islamic finance in Africa. One has been contracted by Edward Elgar. The other one will be Routledge. So I invite anyone, if you have a paper that you have written on any aspect of Islamic finance in African continent, please do contact me. I say you're a fan of Mohammad, I know, but we try to add to him, okay? What to that?
Okay, thank you. Thank you.
Thanks very much.
Thank you, Kabir. Thank you. Thank you.
And thanks, Kabir. I know that one thing you have in common. I know, Aisha's work at SOAS and the work that she's doing now. She's manufacturing, by the way, quite a lot of papers, very prolific indeed. And one methodology in common with what you have used here, Kabir, is the construction of that index, which is very, very competent reported. So using principal components analysis. So I suppose you concur there, and that's why Aisha didn't raise any question, I think, in
Yes,
regard.
yes,
Yeah. And thanks, Kabir, for inviting members of the group here for contributing a chapter to the book you are editing. You can be sure, I can see a number of names that are interested in that area. You can be sure that you'll get a lot of attention. Quite a number of prolific guys here. You don't be surprised if you get one next week from George Okello, is producing quite a lot of work in related areas. Okay. I don't know whether given that Hassan Bana is here, Hassan, if you want to say something, please feel free to add to this discussion. Since you are co-author in the paper, you should feel free to come in if you wish. Okay. There is a hand up, one hand up, and this is from Dr. Ruiz Rene Peter Rose. who is the immediate former Minister of Finance of Seychelles, but also the Executive Director of the World Bank. I mentioned that because there are very important policy questions here, and I'm sure having been running on the policy socket for so many decades, there are many questions that he may want to is put forward. That's why he put up his hand. So, Peter. I think you are still muted. Yeah, okay. You are muted.
Thank you, Mr. Chairman. Kabir,
Yes.
good work, well presented, very sophisticated, very innovative. But from a policy perspective, I would like to ask you, you collected data from various sources. So what were the challenges that you face to try and get a systematic set of data? You could have used a pool power based set of data, balance or unbalance. You've used principal component analysis. So what were the challenges you faced to synchronize all these data? Because each country's data to a certain extent varies. So this is my first question, because at the end of the day, the policymakers has got to make a decision on reliability and sort of soundness of the data and policy outcome. Thank you for the time being.
Excellent question, Doctor. That is a $1 million question, because when you make a policy, you want to make sure the data is not garbage. And the data collection process of the sources that I have mentioned. So our reliability is as good as they are reliable in their collecting data process, because we did not collect the primary data. We believe that they have done the right way, but there's probably a question of their, like global index database was done by the World Bank, spending a lot of money with the Bill and Microsoft Gates and Melinda Foundation money. So to answer your question, I know you're asking very probing question, micro level. I really do not know, but I do know from my anecdotal experience of working with different countries, the data quality varies from country to country. Now, one of the reasons also why our policy fails in different developing countries, because most of the lessons that we learn from developed countries, whereas more developed, we try to implement those policies in developing countries, assuming they have the same structure. But many cases, their structure is different, and what is their structure, what is the current situation, we do not have a full picture of it, because we do not have quality data collection, processing, and curation. And that has been a problem. Like if you look at, just a side note, if you look at the academic journal, you will not find many papers published in top journals, for example, African continent, because some way it's a forgotten continent. People, they do not collect data, curate the data, and of course there's a brain drain too. Unfortunately, brain drain is a big issue of the developing countries. It's for knowledge brain drain for many of us, and for many of us it's an economic brain drain. But the knowledge brain drain is more pitiful, because these people could have been contributed a lot in their respective countries, but they do not have the environment. Like for example, I don't want to go back to Bangladesh. I could have contributed, because if I go there, instead of helping the policy making process, I will become an obstacle to them, because I'll be talking about all these beautiful things. And not only that, I will also have an obstacle going back, because the existing the policy making body is not going to allow us to go back and share it. So sometimes I feel that expatriates, the knowledge sharing part probably is very important, and World Bank and IMF probably can encourage policies like this, sort of transfer of knowledge, instead of creating a framework so that these people in Bangladesh, for example, are not threatened by me, or also me not threatened by people of Bangladesh. I think the same policy probably applies to many developing countries as well. One thing I can tell you, I mean, this, forced upon policy perspective in different countries is not going to work. I give a recent example. In Bangladesh, financial inclusion number is pretty good. It's not the highest, but they have introduced an agent banking. So since you cannot really, digital infrastructure is not there to the level where you can penetrate different sectors of the economy, urban and rural. And the rural in Bangladesh, like many developing countries, is about 70%, and that generate agricultural-based economy and so on. Now, since you do not have the digital except the mobile technology, so they have created different banks, agent banking. So using the mobile technology to collect deposits and do the banking services, and that has increased the financial inclusion significantly in the context of Bangladesh. Kenya's M-Pesa and different countries have example like that. So, dear doctor, that's all I can tell you. You are on the other side, policy making body. You asked this probing question, but that's the best I can answer you.
Thank you, Kabir, and thank you, Peter, for making those important observations. Let's go back. I think in the audience, I can see George with his hand up. So George, please unmute and go ahead.
Yes, hello.
Hello.
Thank you very much,
Very well.
Kabir. Yes, thank you very much, Kabir, for the presentation. This is really very good in scaling up financial inclusion, especially in developing countries. Now, I would like to share with you my experience in Uganda. In Uganda, what's happening is that we have the mobile network operators. So the mobile network operators have their outlets for mobile money. So they have the mobile money agents. Now, recently, the mobile money agents have overtaken the operation of the banks in extending financial services through the mobile money. So I was wondering, because through the mobile money agents, you find that many people in the community were accessing financial services through the agents, which are located near their, of course, near their homes and their workplaces. Now, this in a way had to drive away the customers from the banks to use mobile money, which is provided by the mobile network operators. And I was wondering if this was not causing some kind of instability among the banks, because you find that in the case of Uganda, the central bank had to intervene and take control of the mobile money operation in Uganda. So how do you relate this kind of scenario to DFI and bank stability?
Okay, that's an excellent question. So first of all, this mobile money technology falls under the definition of DFI that I'm talking about. Now, that disruption that you're talking about, of course, is creating a competition among the banking sector. And there's another strand of literature whether the competition is helpful to financial stability or detrimental. So again, there are two groups of scholars say that it is helpful, competition promotes financial stability. The another group say that no, actually disrupts financial stability because of this competition among the banking sector, and they're creating more uncertainty, flow of money. Now the central bank, of course, have to get in because it's the payment mechanism that you're talking about, and of course it's collecting deposit. I do not know, you said that Central Bank of Uganda controls its mobile money technology, or it's totally free?
Yes, exactly. It's not the one overseeing the mobile money operation.
So they oversee the mobile money operation, right?
Exactly. Because the mobile money agents were outcompeting the banks. And actually, most of the mobile money operations are being conducted through the mobile money agents and not through the banks.
Okay, by understanding.
So the linkage between the mobile money operators, the mobile money providers, and then the banks, there's actually a gap between the mobile money providers and then the banks, because they prefer to offer financial services directly through the mobile money agents. So in this case, they tend to outcompete and push away the commercial banks or the banks in the use of DFI.
That is okay. That's very interesting. But in the context of Bangladesh, the agent banks that you're talking about, it is the agent of the bank itself. So they have agent with the mobile technology, different parts of the country, and they are connected with the bank. So they are not, banks are not competing with the agent banking. So this is an extension of the banks. But what you are saying, the mobile money operators sort of work independent of the banking system, and they try to arbitrage. So
exactly.
They will, yeah, and that is probably disruptive. I think if my humble submission is that central bank has to control this process. How they do it, I do not know, but that is also creating an unequal. Of course, you know, this mobile technology, because of low cost, as Victor said before, you know, they can run things more efficiently than a bank, because bank has a physical infrastructure, operation cost is very higher. So I think the central bank of your country should really sort of find a balance between these two sectors. If the idea is that they want to compete or create a competition in the financial services provider, they should do that, but they should have a level playing field. This mobile money operator do not have capital requirement, deposit insurance requirement, and so on. So it is putting the conventional banking system is at risk or as a competitive disadvantage. So if we allow this mobile operator agent banking have the same level playing field for everyone. So once you impose this regulatory constraint, you see they behave more responsibly. So the arbitrage, this unhealthy competition will be reduced. So yes, they have to make a level playing field. That will be my humble submission. Right now, they do not.
Yeah, because yeah, we have the mobile network operators have the mobile money agents, and as well we also have the agent banks that operate through the agents, and they have a link with the commercial banks. But the mobile money agents are actually very many than the agent banks.
Okay, I see.
Yeah, thank you very much. We are looking at the level of scale, and there are a number of issues, especially in this strand of literature on digital financial inclusion and on bank stability, which may require a different approach. For example, which may rely on a fieldwork, microdata. For example, if I was to investigate this question, the same question that Kabir poses, but I wanted to use randomized controlled trials, then I would be cutting out a portion, say George mentioned Uganda, so I would be cutting up a section of a central Kampala and the outskirts, and then maybe another extreme end in Kabale, and then another extreme end in Guru. And then I would be taking a baseline survey of the persons and the financial services sector in that area. I would then making an intervention in terms of seeing, how introduction of a component of digital, advancement of digital influencing the behavior as a theory of change. And then after 1 year, then I would be doing an end line. And then from that experiment, I could be able to show, to answer some of the questions which are completely granular. So the same questions, but may require a different approach. What Kabir's study does is to motivate us to look into other aspects that can be able to interrogate the same questions and do it much more, perfectly. So, thank you very much, George, for those contributions, and Kabir for the response. I think Kabir is opening up quite a huge amount of, area that for further investigation at different levels, and maybe some of the policy interventions, or some of the interventions that can be done by central banks and also multilaterals. I can see some people here from the African Development Bank. I can see Grace Chekunda here. It would be, if they had to do an intervention like that, put in money as a project in that area, then they would need to build on Kabir's study, but then do an extra dimension of looking into an area and then kind of be able to do experiments and then innovate, have a product that has an IP, and then that can be implemented through a bank. Okay, so
I think I just want to add something what Victor said. Actually, the central banks of the African countries or many countries really should allow this type of study to go on, because that's the way actually you learn from the field experiment. And you know, we have 2 Nobel laureates this year, and a few years ago they have this randomized control trial technique, you know, to understand from the field how policy intervention works. So right now you have raised the problem. Of course, it's a problem, and my answer was at a macro level, very crude, in a sense that you have to bring them on the same level playing field. Right now, these mobile operators are operating with very little fixed cost, I say, but the banks operate in very high level of fixed cost and financial cost. So they are in competitive disadvantage, and that is disrupting the system. And that disruption is not good for financial stability for any country. So I hope that you will give money to his center, Victor Murinde, so that he can do all the beautiful work.
Thank you. And I can see Deputy Governor, Dr. Kups Mulambo, maybe I will do a project on his, but also seriously, it could be used for also like the quality of finance, okay, which is an extension of this argument, the quality of finance, which is an issue for micro, small and medium enterprises. Those small companies, when they go to banks or even when they go to microfinance institutions, they get money for short term. The quality of finance is not appropriate for the operation. You need long-term finance where they can be financed for 1, 2, 3, 4, 5 years. And that's the quality dimension of financial inclusion. Okay. So I suppose there are ways in which we can do additional study, building on this, of course, to be able to address some of the missing policy dimension and also missing dimensions of the practice of finance.
You know, I just want to add something to what Victor said. You know, very often the bank is created to do short-term financing, mostly working capital. It is not really the model itself does not allow to provide risk capital, long-term financing. So we have to come up with a partnership, risk-sharing type of financing model. That's the quality of finance that Victor is referring to. I'm very much for it. Without that, we'll have like a financial divide, the rich and poor, and the number of the influential book came out, this Piketty's book, that the inequality is increasing, and one of the reason is also having access to finance. I mean, if you look at even the banking sector in Uganda, the banks are a corporate banking. You and me, the 90% of the people do not have a something called corporate banking sector, unless it's a government, state-owned development financial institution. Even if you look at this mobile operator, of course they come down to the line, but still they are not reaching to the poor people. I mean, how many, I mean, in order to send money, you have to have the money, you have to have the savings. So the unforgotten, so the way I look at any banking sector, I mean, any country, if you've got the data, top 20% are served by the banking sector, and bottom 20% are served by the different types of microfinance, and you have the huge potential 60% in between. Nobody is willing to look at them, and there are different interventions, the quality of finance. You can look at the unemployed, educated, young youth population in many developing countries. Some estimates are 30 to 35%, and the government cannot provide them jobs. And the entrepreneurship is connected with the quality of finance. So those are the angles we really should look at from the country perspective, and research should be promoted, encouraged, and funded for this thing. I'm not advocating here just for research itself, but I'm saying that these are the questions we raise, but we never really try to answer it from a scientific standpoint using the real field level data.
Thank you for that additional observation. I can see Dr. Peter Rose, your hand is still up. Is that a legacy hand or is a new hand? A legacy from the previous one. Okay, okay. Things gone down. Any further additions, observations, and oh yes, please go ahead. Yes. Okay, okay.
Thank you, Mr. Chairman, for allowing.
Yeah.
Yeah, thank you, Mr. Chairman, for allowing me to come a second time. Kabir has certainly opened our eyes on many complex issues. But then at the end of the day, given that the set of data, which is difficult to synchronize, and I'll give you a typical example. I don't know if you are really well in tune, even the World Bank, when I say about reliability of the data. Recently, and even just now, there's a huge scandal of the doing business. You've heard about that, you're laughing.
Yeah, I do.
Yeah?
I do. Laughing.
It's a huge scandal, and you can imagine, just a heavyweight institution manufacturing data, manipulating data. Then one tends to ask, what about this small micro institution? How can they would navigate and be able to falsify data? I'm sorry to say we are in a lost world. I'm very passionate about it, and I'm very serious about it as a policymakers. If an institution like the World Bank manufactures data for certain political issues, then we've got something big coming our way. Thank you so much.
I agree with you totally. I agree with your sentiment and the scandal that happened recently. But again, we really need to find the answer of whether there was a scandal. I mean, on the face value, we shouldn't really, because I see a controversy because the lady who is the IMF chief, she said that she didn't do anything undue. So, but the audit report came out, as you said, it says otherwise. But yes, if this responsible institution do hanky-panky like this, where do you go? I mean, for this last resort, they are supposed to, I mean, create the standard for us to follow. I mean, as a world organization, I'm talking about. But I think ultimately we have to really, I believe in, endogenous growth. I mean, we have to look at the potential of Uganda. We have to grow within our culture context what are supposed to do. Now, very often we have followed the prescription of the World Bank and IMF. I said they do this experiment, developing countries, they find the best practices, but the best practices are not be the best in many of the developing countries. And since you are the policymaker, you do at the micro level, you know what policy works and what policy doesn't work. But we are somewhere tied to the World Bank and IMF because we need, short-term emergency funding or the long-term funding. The World Bank puts all the conditions, does not really give you a free hand to spend the money. But at the same time, we have also a problem because we have a high level of corruption, right? So World Bank cannot trust us too. So we really have to develop both ways. We have to grow ourselves in order to reduce the level of corruption. At the same time, World Bank has to come up and look at the country-specific way of the development agenda rather than one size fits all for all countries. That's for now, Victor.
Thank you very much. Thank you very much, Kabir, for making those additional observations, and thank you, Peter, for raising those points. Yes, I think I would like to invite more contributions, discussions from the floor. I can see quite a number of people who are also working in this particular area. If they have something to share with us or additional observations to make, or seriously thinking of the next piece of work that will provide an extension from here, or even producing a work for the next, the invitation that Kabir has mentioned. I can see people, for example, Ibai, who is leading in this work of the interbank market, and not sure whether Islamic banks are participating in the interbank market, but why not? I think that would be absolutely interesting. And I think even when we speak about bank stability, the interbank market has a role there in terms of that's where all the banks are trading. I can see Ibai's button flashing. Maybe she wants to come in.
Thank you, Victor. It's a very interesting presentation for sure. When we talk about digital financial inclusion, then the interbank market has quite relevant role there. So yes, but I think our particular paper wasn't really looking at the trading aspect. But we do look at the network connection. So yeah, it's not quite directly on the trading as a sort of digital platform as such. I just want to make a little what you said about data. So currently, I have a PhD student working on the micro and small enterprise financial inclusion issue, and she actually is going to use some questionnaire survey to collect primary data. So I wonder if there's any suggestions or comments, probably from people here today, about if there's any concern, or we do have concern. What do you think could be the concern for using a survey to collect primary data in this particular case?
You're talking about this interbank market or overall?
Oh no, I'm talking about financial inclusion, help the micro and the small enterprise in terms of getting access to finance and promote their employment, hence promote their performance.
Well, my concern would be why you want to collect it, because fast data and Findex has collected all this thing. Unless you have a specific region or country, you want to do a more micro level of study. I'm just curious why that would be.
Yeah, because we were looking at China, and this is going to be individual firm level data.
Okay, so I think, yeah, this a fast database does not go that country level or micro level data. Yeah, that would be interesting. But the question is, how do you do that? You are based in where? In China right now or in UK?
I didn't introduce hereby has been working with us as a co-I on a huge research project. And just moved from the University of Nottingham in the UK to Liverpool Xiantong University in China, where she's a professor now. So I think she's.
So I'm in China at the moment.
Yeah.
Yeah.
So how receptive? I'm just curious because I do not. How receptive government of doing this type of survey work? The government does not have any restriction on running survey like. Oh, okay.
I don't think so. No, I don't think so. It's a pure just academic research. No, government does not have any restriction on that.
Okay, I think that would be interesting. So if you want to, China will become a next laboratory. There was a very influential paper came out recently. 86% of the research are done on the United States data.
Yes,
now,
indeed.
And the 14% of the rest of the world. And China becoming, second, and pretty soon will number one. And China will become next laboratory of our academic research as well. And you probably are familiar with there is a number of databases only on Chinese market, the financial data and other types of data. And I'm sure being in China, you are familiar with that one. Before you invest money and time into this thing, look at what is available, whether those data can really answer a research question. And that's how we can save time and money. If it is not, then fine, and make it a very focused study and develop the questionnaire and do follow the survey method that you usually do. But in this case, I just came to know, I was attending another webinar yesterday. Somebody said blockchain technology is now being used in order to collect survey, do survey. I was not familiar with that. And China being financially savvy as well, the Chinese population in general, you can use some sort of artificial technology or blockchain technology in order to do your survey. And that will be unadulterated, we call this. It will be more representative of the actual phenomena. So you can look at the blockchain technology. Yes.
Yeah, thank you. That'll be interesting. That we certainly connect to the very sort of trendy or hot topic. And the existing data sets, the large ones are normally focusing on household financial inclusion. So yeah. In China, what I mean, yeah.
Okay, great.
So you're looking at family level financial inclusion.
Right. We're looking at enterprise, small and micro. Yeah, but the existing data set are mainly on family household level.
Okay, yeah.
So is your government taking an initiative to run this? Because this is a big macro level initiative and huge capital intensive research.
No, it's just PhD student work. So yeah, it is very expensive because collecting survey means money.
Right. Yeah.
Yeah. Thank you.
Thank you.
Thank you, Victor.
Very much. Yeah, thank you indeed. Thank you, Kabir. Okay. I can see one hand up. Let me check that. It's supposed to be another hand. Okay, it's another hand. Okay. Okay. So I suppose at this juncture, it's my great pleasure to once again thank you, Kabir, not only for presenting an exciting paper, but also for presenting it brilliantly and for exciting our minds to think much more actively about the work, the results found, and of course the implications for policy, and also for the invitation to us to contribute to some of the ongoing work you are doing. It may also well be the case that you'll get a lot of contacts after this session. The discussion in the Center for Global Finance does not stop with the seminar only. It actually extends, and the more work goes on, interactions, networking, and so, that would be, the great work. But we thank you very much for making the time and preparing a lot of work to share with us. We also thank you, all the participants, because we would not have a seminar if you didn't turn up and if you didn't sacrifice your time, and also for the great discussions we have had on this important idea. Next week we have, in terms of the university term, we have what is called a reading week. In the reading week, it's a break, so we all take a break and focus on finishing our papers. We want to run a seminar on next Wednesday as a reading week, but we shall be back on the 17th, that's the week after, with a brilliant book launch that's coming out of Oxford University Press, and some other discussion with the team. And Menga, as usual, will be reaching out to you in due course. So thank you very much. And I think for those in the US, it's still good morning. And the rest of the world is supposed to be good afternoon or good night to people maybe in China. Thank you very much. Thank you very much. And see you soon. Thank you. Thank you very much.
Thank you, everyone. Thank you, Victor, for inviting me. We'll see you again, inshallah.